Before anyone changes your pension because of the April 2027 rules, stop. Because the wrong decision could mean transferring out of valuable benefits, taking tax-free cash for no reason, gifting money you'll later need, or buying life cover that does not actually solve the problem. Some advice will be right, some advice will be wrong. The difference is whether anyone has asked the proper questions first. So, in this final episode of the 2027 Pension Reckoning series, I'm going to go through 5 questions that could stop a bad pension decision after 2027. Welcome back to Money Under the Microscope, where we make finance clear. Now, let's bring it all together. Why these questions matter. The problem with the April 2027 pension change is that there is no single right answer. The right move is not automatically to transfer, gift, draw more income, take tax-free cash, or buy life cover. The right move depends on your estate, your pension, your beneficiaries, your tax position, and your retirement plan. These 5 questions help you test whether the advice is genuinely built around you. Okay, so let's look at question 1. Have we actually worked out whether my estate is likely to face inheritance tax after April 2027? Now, this is the first question, because before anyone talks about solutions, you need to know whether there's actually a problem. What you're really asking is, am I genuinely exposed to inheritance tax, or am I just reacting to a headline? The 2027 pension change will not affect everyone in the same way. Some estates will still have no inheritance tax problem, and some will have a bigger problem, and some may only have a problem later if the pension grows, property values rise, or family circumstances change. A proper answer should look at your home, savings, investments, pensions, spouse or civil partner position, allowances, previous gifts, beneficiaries, and likely future growth. Numbers matter. The red flag answer is, your pension is going to be taxable, so we need to move it. That is not enough. Before anyone talks about transfers, gifts, life cover, or tax-free cash, they need to show whether you actually have an inheritance tax problem in the first place. Because if the problem has not been measured, the solution is just guesswork. Okay, let's look at question 2. Have you included my pension properly in the estate calculation? And what happens before and after age 75? So this question does 2 important jobs. Firstly, it checks whether the advisor is planning under the new rules. From April 2027, most unused pension funds and pension death benefits are expected to be brought into the estate for inheritance tax purposes. So your pension cannot just be treated in isolation. It needs to be looked at alongside your home, savings, investments, beneficiaries, and your wider estate. Secondly, it checks whether the advisor understands the age 75 issue, because inheritance tax is not the only tax people need to think about. If someone dies after the age of 75, beneficiaries may also pay income tax when they draw inherited pension money. Now, that does not mean every family faces 2 layers of tax, but it does mean the advisor needs to explain both possibilities clearly. What happens before 75? What happens after 75? Who receives the pension? When might tax be due? And how could the beneficiary's own tax rate affect the outcome? And the red flag is simply, don't worry, your beneficiaries just inherit the pension. Now that's too vague. The better answer explains the estate position, the inheritance tax position, the income tax position, and how beneficiaries' own circumstances could change the outcome. Now let's look at question 3. Should I draw more income or take tax-free cash? And where would that money actually go? This is where lazy planning can become dangerous. After April 2027, one simple answer may be, just take more out of the pension, or take tax-free cash because it's tax-free. But neither of those is a plan. If you draw more pension income and it just builds up in your bank account, it may still be inside your estate. And if you take tax-free cash and have no clear purpose for it, you might simply move money from one problem into another. So the real question is, are we using the pension deliberately or just reacting? A proper answer should explain how much income you actually need, whether drawing more improves the estate position, whether tax-free cash has a clear purpose, and whether phasing it makes more sense. And the red flag answer is, take it because pensions are now bad for inheritance tax. Now that's not planning, that's a shortcut. The pension is not automatically the enemy. The question is how it fits into the wider plan. If this video is helping, please do consider subscribing. This is still a new channel and I'm trying to grow it into a place where UK personal finance is explained clearly without the noise, jargon or panic. It really does help the channel reach more people. Thank you. Let's look at question 4. Before moving or consolidating anything, have we checked what I might lose? Now this is one of the most important questions in the whole series. When pensions are scattered, consolidation can feel obvious. One pot, one login, one statement, simple. But simple is not always suitable. Some older pensions may have valuable guarantees, protected tax-free cash, safeguarded benefits, exit penalties, or death benefit options that may not survive a transfer. So before anything moves, there should be an audit. What do you actually have? What are the charges? What are the investment options? What guarantees exist? What death benefit options are available? And what would be lost if the pension was transferred? And the red flag answer is, it'll be easier if everything is in one pot. Easier is not the same as better. Tidy is not always better. Simple is not always suitable. A good advisor should be able to explain not just why something should move, but what you are giving up by moving it. Okay, and let's look at the final question. Question 5. If gifting, life cover, trusts, or any other planning route is being suggested, how does it fit into my actual plan? This is the big final question, because once inheritance tax becomes the focus, people can become obsessed with reducing the tax bill. But tax is not the only risk. Running out of money is a risk. Future care costs are a risk. Giving away too much is a risk. Losing control is a risk. Relying on family members is a risk. Using complicated planning you do not understand is a risk. So, if someone suggests gifting, life cover, trusts, or anything else, the question is not just, will this reduce inheritance tax? The better question is, can I afford this? Do I understand it? And does it fit my life? A proper answer should consider affordability, cash flow, health, family circumstances, care costs, loss of control, and whether legal or specialist tax advice may be needed. And the red flag answer is, you need to gift this much, or you need life cover to cover the tax bill, without explaining whether you can afford it, whether it fits your life, or what new risks it creates. That is product-led, not planning-led. The answer is not always to transfer. It is not always to gift. It is not always to draw more income. It is not always to take tax-free cash. And it's not always to buy life cover. The answer depends on your personal situation, your estate, your pension, your beneficiaries, your tax position, your retirement plan, and the people you may leave behind. This is what advice should actually do. It should connect all the pieces. This series has given you the context. These 5 questions help you test whether the advice you are getting is genuinely personal, or whether someone is using the 2027 pension change as an excuse to sell you something. Because after April 2027, your pension may still feel like yours. But if it is left behind, the consequences may belong to the people you leave behind. If this is the first video you've seen in the series, I've put the full 2027 pension reckoning playlist in the description. That playlist walks through the pension rule change, the tax problem after 75, gifting, tax-free cash, consolidation, and the mistakes people need to avoid. Thank you for watching. Please subscribe to Money Under the Microscope, making finance clear.